welcome back to my YouTube channel. My name is Rajat and today we are going to talk about very important three concepts. Those are PD, LGD and EAD. So I am going to tell you so many important things about three of them. So without wasting any time, let's move forward. Let's start discussing. So first of all, let me mention the topics. So we are going to talk about ratings because all we check the customer, that what is the rating of the customer, we check that. So we talk about rating models. This is number one. Then we are going to talk about credit parameters. And third, we are going to talk about model uses. Now across PD, LGD and EAD, we will talk. So PD stands for probability of default, LGD stands for loss given by the default, EAD stands for exposure at default. PD means what is the probability that a customer who has taken the loan will default. LGD means what is the loan default will impact to the bank if any borrower default at a certain period of time. That is loss given by the default. And the third matrix is EAD, which is how much the exposure is at default at a particular point of time, because exposure would be changing time by time, LGD would be changing time by time. So all those things do matter. Now these are the three important metrics and all three are used to calculate the ultimate thing, which is ECL, expected credit loss. That is the byproduct of three of them. Now the three concepts itself have their own certain characteristics and properties. So understanding that is very important. Now let's talk first about PD models. So now when we talk about PD, so there is a very well-known term which is used in the banks, that is known as borrower risk ratings, or we can call them customers also. So we can say customer risk rating or borrower risk rating. So we call this concept CRR or BRR. So these, what is the borrower risk rating and how this is associated with probability of default? So probability of default is a mathematical number. For example, that there is a chance that anybody will default 30%, right? Now BRR or CRR, this risk rating are divided into kind of scaling method. Like the best customer in your database will be considered as AAA. That is the topmost. Then you will have AA rating. Then you have single A rating. Then you have triple B rating, for example. Then you have double B. Then you have B. Then you have triple C. Then you have double C, and the C is the worst rating. So this is the rating, or you can say scale, which different bank use to give the customer a bucket. Every customer would be part of either this bucket or this bucket or this bucket or this bucket, depending on the kind of formula which we have been using, right? Because every bucket would be having their own semantics. Now, to understand this in much more detail, you should focus on this term CRR. Okay. So how the PD and CRR are associated at the moment? Let's talk about that. So when we say rating, as I said, right, so that triple A, double A, then A and all, right? So that is the difference between a PD and CRR. But when any bank is calculating PD, they usually do CRR thing. That's why CRR is important. Why? Because PD will tell you 0.01%, 0.03% or something like that in terms of probability. CRR will tell you the how many customer are in this bucket, how many customer are there in this bucket, and how many customer are in C bucket. So those are the worst customer, best customer, second best customer, and all that bifurcation. Now that's why it's very important. Now when we talk about BRR, BRR or CRR have some master scales which are used there, right? So there are certain things you should remember always about these two concepts. Number one is these are the measures of likelihood. These are the measures of likelihood that borrower is not able to meet, that borrower is not able to meet financial debt obligations. This is something you should remember, okay? Because that's what the purpose is. We need to identify the people who are not able to meet the debt obligations, okay? Then this captures default customer list. This is again a very important thing because we need the list of those customers who are totally at the default, and also we need the list of those customers who are the best customer, because we will sell them more product, and the process is known as cross selling, okay? Then this represent friction of population, friction of population of borrowers within a grade that is expected to default in next 6 months or 12 months or 18 months, all of that. So that's why this is very important. Now one more thing to understand here is, always remember PD will be always in this form. This is just one example, okay? And CRR rating will be always under kind of a bucket. It can be anything. So AAA. Some bank will say I plus or anything like that, okay? So this is all about PD model and BRR. Now let's talk about LGD. So in LGD, it is loss given by the default, right? That is number one thing. Now this is the measure. Number one, LGD is measure of economic loss. Economic loss, right? Economical loss we also call it. So like it's just the pronunciation, okay? So this is the measure of economic loss for credit facility. Measure of economic loss of credit facility if obligor default. So this is one thing you need to always remember about LGD. Second thing, it helps capture recovery risk. It helps banks understand and capture that how much risky the recovery is in this particular case, and how much impact this recovery will do to us if it is not properly going in the right direction, okay? And this provide the inverse of measure, okay? This provide the inverse of measure of protection provided by collateral. It can be the house or any collateral which the person has given to the bank, okay? And supporting structural element. So this is something you need to always remember about the LGD. Now in the EAD part, let's talk about EAD. Now EAD stands for exposure at default. Obviously this measures the anticipation. It basically measures the anticipation outstanding amount of credit facility, if default happen. So this statement completely justify the use of EAD. Now second thing which you need to remember about this, it captures the additional drawn amount. It capture additional drawn amount. This is something again very important to remember. And if I talk about the third thing, it represents the current outstanding current outstanding. So it basically shows the current outstanding plus certain level of undrawn plus undrawn percentage of product. It can be loan, it can be credit card, and anything. Okay. So that's something you should always remember about all these three concepts. Now, what is the purpose of three of them? If I combined this, combined this, combined this, so it creates the ECL. Now, what is the use of these, right? As we started in the video, we have spoken about rating models, credit parameters we have spoken. Now, what is the use of this? That is something we need to understand. So when bank is calculating three of them, there are many uses for that. But let me talk about main use. Main use, why we calculate all these terms. Okay. Number one and most important is regulatory reporting. Like in India, you know RBI. So all the bank need to report their numbers, everything to RBI. That is again important. Number two, to satisfy the banking guidelines like IFRS 9 or Basel models. This is again comes under regulatory umbrella only. It help bank to manage economic capital to absorb any shock in the market. That is the third most important use, that banks should be able to get that shock in terms of stress in the economy, right? Then it helps to the third line of defense and second line of defenses which are there, like the validations and governance to track health of portfolios. Now, this is the overall use of this. Okay. So now I hope this is clear to you. It was kind of a informative video to understand that how we need to justify these three metrics. Okay. So this was more of a theoretical approach. I know that, but before before thinking that this is completely a theoretical approach, the focus should be to understand the concepts, because the concepts are important. That is something you are able to grasp here. Okay. Now one thing to remember, that PD models or LGD models or EAD models are not something calculated just within one simple equation. All of them have there so many nuances which you need to calculate internally, and there are so many fair enough of estimations which you calculate, like overrides and exclusions, and then sometime there are some discounts and everything. So that is something bank usually follow. On that note, if you like this video, please subscribe to my channel. And if you have any question concern around this one, make sure you put the comment and I will reply to your comment. Thank you so much. All the best.